Since launching in 2024, Bitcoin ETFs have had a massive impact on the Bitcoin network. They have made it easier than ever for people to get exposure to Bitcoin, and as a result, they've brought in a tsunami of new money. But there are downsides. So how do Bitcoin ETFs work? Are they right for you? And what is their real impact on Bitcoin? Let's break it down. ETF stands for Exchange Traded Fund, a financial product that tracks the price of an asset like gold, stocks, or Bitcoin. A Bitcoin ETF lets investors buy Bitcoin exposure through a brokerage account, just like they'd buy shares of Apple or Tesla. But here's the key difference. When you buy a Bitcoin ETF, you don't actually hold any Bitcoin. You're just buying shares in a fund that holds Bitcoin for you. The first Bitcoin ETF proposals started back in 2013, but regulators weren't ready. For years, the US Securities and Exchange Commission, SEC, rejected them, citing market manipulation, volatility, and lack of oversight. In 2021, a Bitcoin futures ETF was approved, but it didn't hold real Bitcoin, only paper contracts. That same year, Canada approved the first spot Bitcoin ETF backed by real BTC, but the market was small and the impact was limited. Then in January 2024, everything changed. The SEC finally approved spot Bitcoin ETFs in the US, unlocking massive demand. Over $40 billion in inflows came pouring in within the first year, shattering all previous ETF records. Today, you can buy Bitcoin ETFs from giants like BlackRock, Fidelity, Grayscale, and ARK Invest, all holding the actual Bitcoin on your behalf. Bitcoin ETFs are easy, but they're not free. You'll pay management fees, typically between 0.2% and 1.5% per year. Some funds also charge hidden costs like spreads or custody fees. Over time, these fees can eat into your gains, especially during sideways markets. This is important. A Bitcoin ETF is not Bitcoin. You can't send it, you can't spend it, you can't use it in DeFi. You're not in control of the keys. The custodian is. If the fund mismanages the Bitcoin or gets hacked, you're not protected the way you might be at a bank. There's no FDIC safety net. What you have with a Bitcoin ETF is a claim on Bitcoin, not the real thing. This structure puts you personally at risk, but it may also threaten the integrity of the Bitcoin network itself. The more Bitcoin held by giant custodians, the more power those custodians have over the evolution of the network. When Bitcoin network upgrades are proposed, the few corporations who hold all Bitcoin in Bitcoin ETFs may end up with massive influence, and their interests may not align with yours. In other words, the growth of Bitcoin ETFs may make Bitcoin less decentralized, ultimately threatening one of its most powerful characteristics. So what's the upside? Well, institutional capital. Bitcoin ETFs make it easy for pensions, hedge funds, and traditional investors to allocate to Bitcoin without touching private keys or crypto wallets. That's billions in new inflows, faster adoption, at least on the investment use case, and growing legitimacy. But it also means more regulation, centralized custody, and the risk of Bitcoin becoming Wall Street's playground. Bitcoin ETFs are a big deal. They offer price exposure without the complexity of custody, and they're already changing the game. But remember, you don't own the underlying Bitcoin when you invest in a Bitcoin ETF. You own a financial product built around it. If you want to control your own keys, use Bitcoin in real life, and embrace the full power of financial sovereignty, self-custody is the way. Learn more at Bitcoin.com and download the Bitcoin.com wallet to take control of your Bitcoin today.